Have you ever wondered why a company with annual revenue of just around 600 crore rupees commands a market value of more than 4,000 crore rupees? Why are investors willing to pay over 100 times its annual earnings for a business that still generates only modest returns on capital? Is this irrational market enthusiasm? Or is the market looking several years into the future? Welcome to Story Behind Stocks, where we believe successful investing begins not by chasing stock prices, but by understanding businesses. Today, we uncover the fascinating story of MosChip Technologies, a company that sits quietly behind some of the world's most advanced semiconductor products, yet remains largely unknown to the general public. To understand MosChip, we must first understand semiconductors. Imagine every modern electronic device around you, your smartphone, laptop, electric vehicle, smart television, medical equipment, satellite systems, even the traffic lights at busy intersections. None of these machines can function without tiny silicon chips that act as their brains. Designing these chips is among the most complex engineering tasks in the world. It requires years of experience, highly skilled engineers, sophisticated software, and deep customer trust. This is where MosChip enters the picture. Founded more than 2 decades ago, MosChip chose a path that very few Indian companies dared to pursue. Instead of manufacturing chips, it specialized in designing them. In semiconductor terminology, such companies are called fabless semiconductor companies. Rather than investing billions of dollars in fabrication plants, MosChip focused on intellectual capital, its engineers, design expertise, semiconductor IP, and system engineering capabilities. Today, MosChip offers turnkey ASIC design, semiconductor IP, embedded software, product engineering, FPGA solutions, and digital engineering services to customers across aerospace, automotive, consumer electronics, networking, telecommunications, and defense. Over the years, the company has quietly developed and shipped millions of connectivity chips while building long-term relationships with some of the largest semiconductor companies in the world. One of the strongest indicators of business quality is customer quality. Management disclosed that 10 of the world's top 20 semiconductor companies are already customers of MosChip. That is not a small achievement. Large semiconductor companies rarely entrust mission-critical chip design to inexperienced partners. Such relationships are built over many years through consistent execution, technical capability, and trust. Another major milestone came when AI chip innovator Tencent selected MosChip as its design services partner. Winning such customers places MosChip among a relatively small pool of global semiconductor engineering specialists capable of handling advanced chip development projects. But why is the opportunity becoming much larger today than it was 5 years ago? The answer lies in a global transformation. For decades, semiconductor manufacturing and design were concentrated in only a handful of countries. Recent geopolitical developments, supply chain disruptions, and the rapid rise of artificial intelligence have forced governments worldwide to rethink this dependence. The United States launched the CHIPS Act. Europe announced major semiconductor investments. Japan expanded foundry capacity. India introduced its semiconductor mission along with the design-linked incentive scheme to encourage indigenous semiconductor innovation. Management believes these structural changes could create one of the largest opportunities in the company's history. Rather than depending solely on outsourced engineering work, MosChip now aims to build proprietary semiconductor products while expanding turnkey ASIC capabilities. Its Smart Energy Meter IC project under the DLI scheme and participation in the HPC processor SoC development initiative demonstrate this strategic shift. The company's strategy extends beyond semiconductor design. Management is investing aggressively in AI, IoT, RISC-V architecture, automotive electronics, digital engineering, embedded software, FPGA solutions, and emulation technologies. These are not random diversification efforts. They represent technologies expected to drive semiconductor demand over the coming decade. Financially, the transformation has been equally impressive. Revenue has expanded rapidly over the past several years, growing from approximately 198 crore rupees in FY23 to 294 crore rupees in FY24, followed by further growth to nearly 467 crore rupees in FY25 and around 585 crore rupees in FY26. Profit has also improved significantly compared to earlier years, while operating cash flows have strengthened, indicating that earnings are increasingly being converted into real cash generation rather than remaining accounting profits. However, every investment story deserves balance. Despite impressive revenue growth, MosChip's return on equity and return on capital employed remain close to 11%. For an ordinary engineering company, these numbers might appear acceptable. But for a business trading at nearly 130 times earnings, investors generally expect much higher capital efficiency. The market is effectively pricing not the business that exists today, but the business it hopes MosChip will become several years into the future. Recent quarterly numbers also remind investors that semiconductor businesses remain cyclical. Revenue and profitability can fluctuate sharply depending on customer project timing, design cycles, and global semiconductor demand. Management itself openly acknowledges that industry cyclicality and talent acquisition remain among its biggest challenges. Semiconductor engineering depends on highly specialized engineers, and attracting as well as retaining such talent is never easy. Perhaps the most important question is whether today's valuation is justified. Imagine purchasing a small shop that currently earns 1 lakh rupees every year. If someone asks you to pay 1 crore rupees for that shop, you would probably walk away. However, if you become convinced that the shop's earnings will double every year for several years, suddenly that price begins to look more reasonable. This is exactly how growth investing works. The market appears to believe MosChip can sustain exceptionally high earnings growth for many years by moving into higher-value turnkey ASIC projects, proprietary semiconductor products, AI-driven engineering, and global semiconductor partnerships. If that happens, today's expensive valuation may eventually appear justified. But if growth slows materially or profitability fails to improve, valuation itself could become a significant headwind. From observing management communication, one quality stands out. Their messaging has remained remarkably consistent. Rather than changing direction every year, management continues emphasizing semiconductor design services, R&D investment, AI, automotive, IoT, RISC-V, turnkey ASICs, digital engineering, acquisitions, and proprietary semiconductor products. Such consistency often reflects strategic clarity rather than opportunistic storytelling. Institutional investors generally seek businesses where multiple engines of growth can work simultaneously. MosChip appears to be building several such engines: design services, semiconductor IP, turnkey ASICs, embedded systems, digital engineering, government semiconductor initiatives, and future product development. If even a few of these scale successfully, the company's earnings profile could look very different 5 years from now. Yet the story remains unfinished. Can MosChip transform from a respected engineering services company into a globally recognized semiconductor product company? Can it improve margins while maintaining rapid growth? Can proprietary products eventually contribute meaningfully alongside services? And perhaps the biggest question of all, can future earnings grow quickly enough to justify the enormous expectations already reflected in its stock price? Only time will answer those questions. What we do know today is that MosChip is not merely another IT services company. It operates at the intersection of artificial intelligence, semiconductor design, automotive electronics, embedded systems, and India's ambition to become a global semiconductor hub. Those trends could define the next decade of technology. Whether this eventually becomes one of India's greatest semiconductor success stories will depend not on market excitement, but on execution, innovation, and disciplined capital allocation. This documentary is intentionally detailed because every great business deserves to be understood, not merely summarized. Thank you for staying with Story Behind Stocks. Until the next story, remember that the biggest fortunes in investing are rarely made by predicting tomorrow's stock price. They are built by understanding tomorrow's businesses before the rest of the market fully appreciates them. Chapter to the birth of MosChip, India's quiet semiconductor pioneer. Welcome back to Story Behind Stocks. Every great company begins with a problem. Some solve problems people can see. Others solve problems hidden deep inside technologies that most of us never even notice. MosChip belongs to the second category. Most people have never heard of MosChip. In fact, millions of people use products every single day that indirectly depend on companies like MosChip without ever realizing it. To understand why MosChip exists, imagine the world in the late 1990s. The internet was still young. Mobile phones were expensive luxury products. Electric vehicles were almost non-existent. Artificial intelligence was a concept discussed mostly in research laboratories. India was becoming famous for software services, but almost nobody associated India with semiconductor technology. Chip design was dominated by American, Japanese, and European companies. Very few believed Indian engineers could compete in such a highly specialized field. It was during this period that MosChip was born. Instead of competing in crowded software outsourcing, the founders made a far more ambitious decision. They wanted India to participate in one of the world's most sophisticated industries, semiconductor design. To appreciate how bold this decision was, think of building an aircraft. Thousands of people can repair an aircraft. Many companies can manufacture individual parts. But only a handful of organizations in the world possess the knowledge to design the aircraft itself. Semiconductor design is remarkably similar. Manufacturing a chip is extremely difficult. Designing the chip that will eventually be manufactured is even more intellectually demanding. Every tiny mistake could cost millions of dollars. This is why semiconductor companies search for engineering partners they can trust absolutely. MosChip positioned itself as one of those trusted engineering partners. Rather than spending billions of dollars constructing semiconductor fabrication plants, the company adopted what the industry calls a fabless model. Think of an architect. An architect designs a skyscraper. Construction companies actually build it. The architect may never own a cement factory or steel plant. Yet without the architect, the building would never exist. MosChip plays a similar role. The company designs highly sophisticated semiconductor solutions while global foundries manufacture the physical silicon chips. This business model offers several advantages. Instead of investing enormous capital into factories that quickly become obsolete, MosChip invests in engineers, research, software tools, intellectual property, and customer relationships. In semiconductor businesses, intellectual capital often becomes far more valuable than physical capital. Over time, the company expanded its expertise into multiple areas. It began offering semiconductor IP, semiconductor design services, turnkey ASIC development, embedded software, digital engineering, system design, FPGA solutions, product engineering. To someone outside the industry, these may sound like technical jargon. Let's simplify them. Imagine someone wants to build an entirely new electric car. One company designs the engine. Another designs the battery. Another develops the software. Another integrates every system into a complete vehicle. MosChip performs similar engineering roles, but instead of cars, it works on electronic brains. Sometimes it designs an entire chip. Sometimes only specific components. Sometimes the embedded software that controls the chip. Sometimes the complete electronic system. This flexibility allows MosChip to serve customers across many industries. Its technologies eventually find their way into automotive electronics, aerospace, defense systems, industrial automation, telecommunications, networking equipment, consumer electronics, smart energy systems, and increasingly, artificial intelligence applications. One of the strongest validations of the company's journey comes from its customer list. Management disclosed that 10 of the world's top 20 semiconductor companies have become MosChip customers. Pause for a moment and think about what that really means. These are companies that can choose engineering partners from anywhere in the world. Yet they repeatedly choose an Indian semiconductor design company. That trust cannot be purchased through advertising. It is earned through years of flawless execution. Another milestone arrived when AI semiconductor company Tenstrent selected MosChip as a design services partner. As artificial intelligence becomes one of the biggest technological revolutions of this decade, partnerships like these could become increasingly important. The company also revealed that it has participated in more than 50 ASIC tapeouts. For someone unfamiliar with semiconductors, imagine writing an entire book. You can edit the manuscript hundreds of times, but eventually, one final version goes to the printing press. Once printed, changing mistakes becomes extremely expensive. A semiconductor tapeout is similar. It represents the final design sent for manufacturing. Successfully completing dozens of tapeouts demonstrates engineering maturity and customer confidence. But MosChip's ambitions extend beyond simply providing engineering services. Management now wants to move higher in the value chain. Instead of only helping other companies design chips, MosChip wants to create its own semiconductor intellectual property and application-specific products. One example is its smart energy meter integrated circuit being developed under India's design-linked incentive program. If successful, this transition could gradually transform the business from a pure services company into one that also earns recurring income from proprietary technologies. That is often where the biggest value creation happens. However, building intellectual property is neither easy nor quick. It demands years of research, significant investments, exceptional engineering talent, and enormous patience. Fortunately, management appears willing to make those investments. They continue strengthening research and development while expanding into AI, IoT, automotive electronics, RISC-V architecture, digital engineering, FPGA technologies, and emulation services. These are not fashionable buzzwords. They represent technologies expected to dominate semiconductor demand over the next decade. In many ways, MosChip's story reflects India's own evolution. The country that once became known primarily for software outsourcing is now attempting to build deep technology capabilities in semiconductor design. Government initiatives like the India Semiconductor Mission and Design-Linked Incentive Scheme are creating opportunities that barely existed a decade ago. MosChip, having spent over 25 years building engineering expertise, now finds itself standing exactly where multiple global technology trends intersect. Artificial intelligence, electric vehicles, 5G, industrial automation, smart energy, defense electronics, digital transformation. Whether MosChip ultimately becomes one of India's semiconductor champions will depend on execution. But one thing is already clear. The company was never built to chase short-term market excitement. It was built patiently, one engineer, one customer, one chip, and one relationship at a time. And sometimes, the strongest businesses are not the loudest. They're simply the ones quietly solving some of the world's most difficult engineering problems. In the next chapter, we will explore how MosChip actually earns money, who pays for its services, and why understanding its business model is the key to understanding its future. Chapter 3: How MosChip Makes Money. The business model behind the Silicon Revolution. Welcome back to Story Behind Stocks. Imagine walking into a luxury restaurant. You enjoy the delicious meal, praise the chef, and leave satisfied. But very few people think about who supplied the ingredients, who designed the kitchen, or who manufactured the sophisticated cooking equipment. Those businesses remain invisible, yet without them, the restaurant could never function. MosChip is one of those invisible businesses. Most consumers will never see its name printed on a smartphone an electric vehicle, a networking device, or a medical machine. Yet behind many of these products lies the engineering expertise of companies like MosChip. To understand why investors are excited about this company, we first need to understand how it actually earns money. Many people assume semiconductor companies manufacture chips. MosChip doesn't. Think of building a luxury apartment. One company designs the architectural blueprint. Another company manufactures cement. Another supplies steel. Another lays electrical wiring. Finally, a construction company assembles everything into a finished building. MosChip is like the architect and engineering consultant of the semiconductor world. Its primary job is to design, verify, optimize, and engineer highly complex semiconductor chips and embedded systems that customers eventually manufacture through global semiconductor foundries. The company's business can broadly be divided into 4 major engines of revenue. The first engine is semiconductor design services. This remains the heart of MosChip's business. Imagine a global semiconductor company planning to launch a next-generation processor. Designing that processor requires hundreds of highly specialized engineers working across digital design, analog circuits, verification, physical design, testing, validation, and system integration. Building such a large engineering team internally is expensive and time-consuming. Instead, many global companies outsource part of this work to trusted engineering partners. MosChip provides exactly these services. The customer owns the final product. MosChip provides the engineering expertise. This business generates relatively stable recurring revenue because large chip development programs often continue for several years. The second engine is turnkey ASIC projects. This is where the business becomes even more interesting. Imagine hiring someone only to design your dream house. Now compare that with hiring someone who designs the house, supervises construction, coordinates contractors, manages approvals, and finally hands over the completed home. The second assignment creates far greater value. Turnkey ASIC projects follow the same principle. Instead of handling only one small part of semiconductor development, MosChip manages the complete journey, from design to verification, testing, and coordination with manufacturing partners. Naturally, such projects generate larger contracts, stronger customer relationships, and potentially better profitability. Management has repeatedly highlighted turnkey ASICs as one of its biggest future growth opportunities. The third engine is intellectual property, often called semiconductor IP. At first glance, intellectual property sounds abstract. Let's simplify it. Imagine Microsoft writing software. Once developed, the same software can be sold repeatedly without rewriting it every single time. Semiconductor IP works similarly. Rather than designing every circuit from scratch, companies often license proven building blocks. These reusable designs save enormous development time while reducing engineering risk. MosChip has been gradually expanding its own semiconductor IP portfolio. Unlike engineering services, where revenue depends largely on the number of engineers deployed, intellectual property can create recurring, high-margin income through licensing. This is one reason investors pay close attention to the company's efforts in proprietary semiconductor products. The fourth engine is embedded software and digital engineering. Modern electronic products are no longer defined only by hardware. Imagine buying the latest luxury car. The engine may be powerful, but features like navigation, voice recognition, advanced driver assistance, battery management, entertainment systems, and wireless updates all depend on sophisticated software. MosChip develops much of this embedded intelligence. Its engineers work on firmware, device drivers, operating system support, cloud connectivity, artificial intelligence applications, Internet of Things solutions, FPGA development, and complete digital engineering projects. As industries become increasingly software-driven, this business segment has the potential to grow alongside semiconductor design. One of the most interesting aspects of MosChip's business model is diversification. Its customers come from multiple industries: automotive manufacturers, consumer electronics companies, telecommunication equipment providers, industrial automation firms, medical device companies, networking businesses, aerospace and defense organizations. This diversification reduces dependence on any single industry. If one sector slows temporarily, opportunities in another sector may continue expanding. Another important characteristic of the business is long customer relationships. Designing a semiconductor chip is not a project that finishes within a few weeks. Large chip development programs often continue for several years. Once a customer trusts an engineering partner, switching to another company midway becomes both expensive and risky. That creates sticky customer relationships. Management has mentioned that 10 of the world's top 20 semiconductor companies are already customers. Relationships of this nature are usually built over years of successful execution rather than aggressive sales efforts. However, every business model has its limitations. Engineering services depend heavily on skilled employees. If engineers leave, knowledge leaves with them. Recruiting experienced semiconductor professionals is neither easy nor inexpensive. This is one reason management continues investing heavily in talent development and research capabilities. Another limitation is scalability. Traditional engineering services grow by hiring more engineers. More projects require more people. That naturally limits operating margins. This is exactly why MosChip is trying to move further up the value chain. By increasing turnkey ASIC projects, by developing proprietary semiconductor IP, by investing in application-specific semiconductor products, and by expanding digital engineering capabilities. Management hopes future growth will come not only from adding more engineers, but also from creating high-value intellectual property. If this strategy succeeds, the company could gradually transition from a manpower-driven engineering business to a technology-driven innovation business. That difference is enormous. Engineering businesses generally earn predictable but moderate margins. Technology businesses built around intellectual property often enjoy much higher profitability because the same innovation can be sold repeatedly with relatively low incremental cost. This explains why investors closely monitor MosChip's progress in areas such as smart energy meter integrated circuits, AI-enabled engineering, risk-free architecture, turnkey ASIC execution, and digital engineering. These initiatives are not simply new products. They represent management's attempt to reshape the economics of the business itself. So, how should we think about MosChip's business model? It is not merely an IT services company. It is not merely a semiconductor company. It sits somewhere between engineering services, intellectual property creation, advanced product development, and deep technology consulting. That unique position gives it access to one of the fastest growing industries in the world. But it also demands continuous innovation. In technology, yesterday's expertise quickly becomes today's minimum qualification. Companies that stop investing eventually become irrelevant. MosChip appears to understand this reality. Its future will depend not only on winning new customers, but on continuously moving higher in the semiconductor value chain. Because in this industry, designing tomorrow's technology is far more valuable than supporting yesterday's. In the next chapter, we will move beyond the business model and explore the semiconductor industry itself, why the entire world is racing to secure chip technology, why governments are investing billions of dollars, and why this global transformation could create once-in-a-generation opportunities for companies like MosChip. Chapter 4: The Semiconductor Industry. Why the world is fighting for silicon. Welcome back to Story Behind Stocks. Before we understand MosChip's future, we need to understand the battlefield on which it operates. Because no company grows in isolation. Every business is shaped by the industry it belongs to. And today, few industries are transforming the world as rapidly as semiconductors. In fact, many experts believe that semiconductor chips have become as strategically important in the 21st century as oil was during the 20th century. That may sound like an exaggeration, but think about your daily life. You wake up to an alarm on your smartphone. You unlock your phone using facial recognition. You order breakfast through an app. You pay digitally. You travel in a car filled with electronic control systems. You work on a laptop connected to cloud servers. You stream movies in the evening. You may even wear a smartwatch that continuously monitors your health. Behind every one of these activities lies a semiconductor chip. Without semiconductors, the modern economy simply stops functioning. This is why chips are often called the brains of the digital world. But here's what makes this industry unique. Unlike many traditional industries, semiconductor demand does not come from just one sector. It comes from almost every sector of the global economy. Artificial intelligence, electric vehicles, 5G communication, cloud computing, industrial automation, medical devices, consumer electronics, defense systems, space technology, Internet of Things, renewable energy. Every one of these industries depends on increasingly sophisticated semiconductor technology. Imagine a city that continues expanding every year. As more people move into the city, demand rises for roads, electricity, schools, hospitals, shopping centers, and transportation. Similarly, as the digital economy expands, demand rises for semiconductor chips. And not just more chips, smarter chips, faster chips, more energy-efficient chips. This creates an enormous opportunity for companies involved across the semiconductor value chain. But then came an event that changed everything. The COVID-19 pandemic. When the world shut down, semiconductor supply chains broke apart. Car manufacturers could not opt in chips. Smartphone companies delayed product launches. Gaming consoles became difficult to purchase. Factories stopped production. Suddenly governments realized something very important. Modern economies had become dangerously dependent on a handful of semiconductor manufacturing hubs located in just a few countries. That realization triggered one of the biggest industrial policy shifts in decades. The United States introduced the CHIPS Act to encourage domestic semiconductor investment. Europe announced billions of dollars to strengthen its semiconductor ecosystem. Japan expanded support for advanced manufacturing. India launched the India Semiconductor Mission and the Design-Linked Incentive Program to encourage local chip design and innovation. For companies like MosChip, these developments represent far more than government announcements. They represent new business opportunities. When governments encourage semiconductor development, demand increases not only for factories, but also for engineers, designers, verification specialists, embedded software experts, intellectual property developers, and turnkey engineering partners. MosChip operates precisely in these specialized areas. Management has repeatedly highlighted these structural changes as major long-term growth drivers. The company believes the industry's recent slowdown is temporary, while the long-term demand outlook remains exceptionally strong. Why? Because technology itself continues evolving. Consider artificial intelligence. A simple internet search performed a few years ago required relatively modest computing power. Today's AI models require enormously powerful processors capable of performing trillions of calculations. Every improvement in artificial intelligence increases demand for advanced semiconductor design. Now think about electric vehicles. A traditional petrol car contains hundreds of semiconductor chips. Modern electric vehicles contain significantly more because software controls battery management, motor efficiency, safety systems, entertainment, navigation, autonomous driving features, and communication networks. The smarter the vehicle becomes, the greater the semiconductor content inside it. The same story applies to smart factories, medical equipment, telecommunication infrastructure, satellite systems, industrial robots. Even household appliances are becoming intelligent. A washing machine today contains more computing power than some desktop computers had a few decades ago. This continuous expansion of digital intelligence creates an ever-growing need for semiconductor innovation. However, the semiconductor industry is not a straight road. It moves in cycles. Imagine a farmer. One year rainfall is abundant. The harvest is excellent. Prices fall because supply is plentiful. The following year rainfall weakens. Production falls. Prices recover. Semiconductor businesses experience similar cycles. Sometimes demand grows faster than manufacturing capacity. At other times, customers reduce inventory and postpone new orders. These short-term fluctuations can create significant volatility in quarterly financial results. That is exactly why experienced investors focus less on one quarter and more on long-term industry trends. Management itself has acknowledged that the semiconductor industry recently experienced a slowdown but believes recovery has already begun, driven by automotive, artificial intelligence, and next-generation communication technologies. Another interesting aspect of this industry is trust. Unlike many products that consumers can easily compare, semiconductor customers cannot afford engineering mistakes. A tiny design error discovered after manufacturing could cost millions of dollars and delay product launches by months. Therefore, semiconductor companies choose engineering partners very carefully. Once trust is established, relationships often continue for many years. This creates opportunities for companies with proven execution records. MosChip's management has stated that 10 of the world's top 20 semiconductor companies are already customers. That statement carries significant weight because trust is one of the industry's most valuable competitive advantages. Looking further ahead, industry experts expect the global semiconductor market to approach $1 trillion by the end of this decade. Think about that number for a moment. A market of that size creates opportunities not only for the largest global companies, but also for specialized engineering firms capable of solving highly complex technical problems. This is precisely where MosChip hopes to position itself. Not as the biggest company, but as one of the most trusted engineering partners in high-value semiconductor design. Yet investors should also remember that great industries do not automatically create great investments. History offers countless examples of excellent industries where individual companies failed because they could not innovate fast enough. Technology rewards today's innovators. It rarely rewards yesterday's leaders. That is why continuous research, talent development, intellectual property creation, and customer relationships remain absolutely critical. For MosChip, the industry provides the wind. Management must still build the sails. The semiconductor revolution may create extraordinary opportunities, but only companies capable of executing consistently, investing wisely, and adapting quickly will truly benefit from it. As investors, understanding this distinction is essential. A great industry creates possibilities. A great management team converts those possibilities into profits. In the next chapter, we will examine MosChip's management itself, its vision, strategic decisions, capital allocation, execution record, and whether the leadership has what it takes to convert a once-in-a-generation industry opportunity into a lasting competitive advantage. Chapter 5: The People Behind MosChip. Can the management deliver on its big promise? Welcome back to Story Behind Stocks. If someone asked you to invest in a restaurant, what would you study first? The menu? The building? The furniture? Those things certainly matter. But eventually, your biggest question would probably be this: who is running the restaurant? Because even the best kitchen, the finest ingredients, and the most beautiful location cannot save a business from poor management. The same principle applies to investing. A great industry can create opportunities. A good business model can create potential. But only capable management can convert opportunity into long-term shareholder wealth. That is why many legendary investors often say they invest in people before they invest in companies. Today, we are going to understand the people steering MosChip Technologies and, more importantly, the vision they have laid out for the company's future. Unlike many management teams that focus only on quarterly numbers, MosChip's leadership has consistently spoken about building long-term capabilities. Their presentations rarely revolve around this quarter's profits. Instead, they repeatedly discuss technology leadership, research, intellectual property, customer relationships, engineering talent, and future semiconductor opportunities. That immediately tells us something important. Management appears to be thinking in years rather than quarters. One of the strongest qualities visible in their communication is consistency. If you study their strategy over the last few years, one theme appears repeatedly. Build deeper semiconductor expertise. Expand turnkey ASIC capabilities. Strengthen intellectual property. Invest in artificial intelligence. Develop proprietary semiconductor products. Expand digital engineering. Grow globally. These priorities have remained remarkably consistent rather than changing with every market trend. Consistency may sound ordinary. In reality, it is one of the rarest qualities in corporate leadership. Many companies chase whatever theme investors are excited about. One year it is blockchain. The next year it becomes electric vehicles. Then artificial intelligence. Then renewable energy. Such businesses often struggle because strategy keeps changing. MosChip's management appears to have chosen a different path. Instead of abandoning semiconductor engineering whenever the industry experiences temporary slowdowns, they continue investing in exactly the same capabilities. That demonstrates conviction. But conviction alone is not enough. Execution matters even more. Fortunately, management has several achievements that deserve attention. During the recent financial years, the company significantly expanded its customer base by adding new customers while strengthening relationships with existing global semiconductor companies. Management also highlighted that 10 of the world's top 20 semiconductor companies are customers, reflecting years of technical credibility and execution. Content reference, OA site, 0, index is equal to 0. Another important achievement is the partnership with Tencent, one of the most closely watched AI semiconductor companies. Winning such a partnership is not simply another customer addition. It represents industry validation. Think about a young cricketer being selected by the national team. The selection itself tells the world that experienced professionals believe in that player's abilities. Similarly, when advanced semiconductor companies choose MosChip as an engineering partner, they indirectly validate its technical competence. Management has also established a new offshore development center in Japan. At first glance, this may appear like an ordinary business expansion. In reality, it carries strategic importance. Japan remains one of the world's most advanced semiconductor ecosystems. Having an engineering presence that improves customer proximity, strengthens relationships, and increases opportunities to participate in larger semiconductor programs. Another aspect worth appreciating is management's willingness to invest before demand fully arrives. Many companies expand only after growth becomes obvious. Visionary companies often prepare years in advance. MosChip continues investing in research and development, engineering talent, AI capabilities, digital engineering, risk-free technologies, embedded systems, and emulation platforms because management believes these technologies will define the future of semiconductor design. Content reference, OA site, 1, index is equal to 1. This approach requires patience. Research spending reduces short-term profits. Hiring highly skilled semiconductor engineers increases costs. Developing proprietary products may take years before generating meaningful revenue. Investors looking only at quarterly earnings may question such investments. Long-term investors often see them differently. They view them as seeds being planted for future growth. One particularly interesting shift in management strategy is its ambition to move beyond engineering services. Historically, MosChip earned most of its revenue by providing design services to customers. While this creates stable business, services usually scale by adding more engineers. Management now wants to create greater value through turnkey ASIC projects, semiconductor intellectual property, and proprietary semiconductor products. Why does this matter? Imagine two businesses. The first sells labor. Every additional customer requires another employee. The second develops software. Once created, that software can be sold repeatedly with very little additional cost. The second business usually becomes more profitable over time. Management appears to be trying to move MosChip gradually toward this higher value model. If successful, margins could improve substantially over the coming years. However, every management team faces challenges. MosChip is no exception. One challenge is talent. Semiconductor engineering is one of the most specialized professions in the world. Highly skilled engineers receive attractive offers from global technology companies. Retaining experienced talent requires competitive salaries, challenging work, career growth, and a strong organizational culture. Another challenge is execution. It is relatively easy to announce ambitious plans. Building successful semiconductor products is far more difficult. Development cycles can extend for years. Customer requirements evolve constantly. Technology changes rapidly. Any delay can postpone commercial success. Management has openly acknowledged these realities. Rather than promising guaranteed outcomes, they have focused on expanding capabilities, strengthening partnerships, and positioning the company to participate in long-term semiconductor growth. That balanced communication generally inspires greater confidence than exaggerated promises. Perhaps the most encouraging aspect of management is that its actions appear aligned with its words. When management speaks about AI, the company invests in AI engineering. When it discusses digital engineering, new capabilities are developed. When it highlights semiconductor products, projects like the Smart Energy Meter Integrated Circuit begin taking shape under India's Design-Linked Incentive Program. Content reference, OA site, 2, index is equal to 2. This alignment between strategy and execution is often one of the strongest indicators of management quality. Of course, investors should also remain objective. Good management does not eliminate business risk. The semiconductor industry remains cyclical. Competition is intense. Customer concentration can create volatility. Large investments may not always generate expected returns. Execution failures remain possible. That is why evaluating management requires balancing optimism with evidence. Based on management's communication, historical execution, strategic direction, and willingness to invest in future technologies, MosChip's leadership appears focused on creating a technology company rather than simply maximizing short-term earnings. Whether that vision ultimately succeeds will depend on execution over the next 5 to 10 years. Because in technology, promises create excitement. Execution creates wealth. As investors, we should always remember one simple principle. A visionary management team can transform an ordinary company into an extraordinary business. But only if vision is consistently supported by disciplined execution. In the next chapter, we will leave strategy behind and examine the numbers themselves. Do MosChip's financial statements support management's ambitious vision? Or are investors believing the story faster than the financials are catching up? That is exactly what we will discover next. Chapter 6, Following the Money. Do the financials support the story? Welcome back to Story Behind Stocks. Every company has two stories. The first is the story management tells. The second is the story the financial statements tell. Sometimes these two stories move together. Sometimes they move in completely different directions. Great investors never rely on words alone. They verify every promise by following the money. Think of a doctor examining a patient. A patient may say, "I feel perfectly healthy." But the doctor still checks blood pressure, heart rate, blood reports, and scans before reaching a conclusion. Financial statements perform the same role for investors. They reveal what is actually happening beneath the surface. So today, let's become financial detectives and investigate whether MosChip's numbers support its ambitious vision. The first number every investor should examine is revenue. Revenue simply means the total money a company earns from selling its products and services before deducting expenses. Imagine owning a grocery store. If customers purchase goods worth 1 lakh rupees today, your revenue is 1 lakh rupees. Whether you eventually make a profit depends on your costs. Revenue tells us whether customers are buying. Profit tells us whether the business is creating value. For MosChip, the revenue story has been encouraging. Over the last several years, the company has delivered strong growth as demand for semiconductor design, embedded engineering, and turnkey projects expanded. Annual revenue has grown steadily from about 198 crore rupees in FY23 to around 294 crore rupees in FY24, then further to approximately 467 crore rupees in FY25 and nearly 585 crore rupees in FY26. This tells us something important. Customers are giving MosChip more work. New customers are joining. Existing customers are increasing engagement. The business is expanding. But revenue alone does not make shareholders wealthy. Imagine a restaurant that doubles its sales by selling every meal at half price. Revenue grows. Profit may disappear. That is why our next stop is profitability. Fortunately, MosChip's profits have also improved significantly compared to earlier years. The company has moved from being a relatively small engineering services player to generating meaningful profits as operating scale improved. Management also highlighted rising profit before tax during FY24, reflecting improving execution. Content reference, OA site, 1, index is equal to 1. This combination of revenue growth and improving profitability is usually healthier than revenue growth alone. However, now we encounter our first important question. If the business is growing rapidly, why are return on equity and return on capital employed still only around 11%? Let's simplify these concepts. Imagine you invest 100 rupee to start a business. If that business earns 20 rupees every year, your return is 20%. If it earns only 10 rupees, your return is 10%. Return on equity simply measures how efficiently management uses shareholders' money. Return on capital measures how efficiently the entire business uses all the money invested in it. MosChip currently generates returns of roughly 11% on both measures. Content reference, OA site, 2, index is equal to 2. These are respectable numbers for a company investing heavily for future growth. But they are not exceptional. This tells us that management is still in the investment phase rather than the harvesting phase. In other words, the company is planting trees. The biggest fruits may still lie ahead. Our next question is even more important. Is the company actually generating cash? Many businesses report accounting profits but struggle to collect money from customers. Imagine selling furniture worth 10 lakh rupees on credit. Your income statement shows profit. But until customers actually pay, your bank account remains empty. Cash flow separates real businesses from accounting illusions. Here, MosChip's financials offer encouraging signs. Operating cash flow has improved over recent years, and free cash flow has also strengthened, suggesting that reported earnings are increasingly backed by actual cash generation rather than accounting adjustments. Content reference, OA site, 3. Index is equal to 3. Healthy cash flow gives management greater flexibility. It allows investment in research, hiring engineers, developing new products, expanding globally, without depending excessively on borrowing. Speaking of borrowing, let's examine the balance sheet. Debt can either accelerate growth or destroy businesses. Imagine purchasing a house. A manageable home loan allows you to own valuable property. Too much debt creates financial stress. MosChip's balance sheet appears relatively comfortable, with manageable leverage compared to many rapidly growing technology companies. This reduces financial risk and provides room for future investment if required. Now let's discuss one number that investors often ignore. Working capital. Semiconductor engineering companies usually complete projects over extended periods. customers may pay after milestones are achieved. This naturally creates receivables or money owed by customers. MosChip's debtor days remain relatively elevated, which means cash collection still deserves monitoring. It is not necessarily alarming for project-based engineering businesses, but efficient collections become increasingly important as the company scales. Another area worth discussing is shareholder ownership. Promoters generally understand their business better than outside investors. When promoter ownership declines, investors naturally ask questions. Sometimes shares are sold for perfectly reasonable reasons, such as funding expansion, diversification, or regulatory requirements. Sometimes the reasons are less encouraging. MosChip has witnessed some reduction in promoter holding over time. While this does not automatically indicate a problem, investors should continue monitoring future shareholding trends alongside management explanations. Content reference, OA site, 6, index is equal to 6. Now comes perhaps the biggest question. If revenue is growing, profits are improving, cash flows are strengthening, debt is manageable, why does the market still debate this company so intensely? The answer is valuation. Think about buying a beautiful house. Even the finest house can become a poor investment if you pay an unreasonable price. Similarly, even an excellent business can disappoint investors if expectations become too optimistic. MosChip currently trades at a valuation that assumes substantial future growth. The market is not valuing today's earnings alone. It is valuing tomorrow's possibilities. For today's valuation to remain justified, investors will likely expect revenue to continue compounding strongly, while earnings grow even faster through margin expansion, high-value turnkey ASIC projects, proprietary semiconductor products, and intellectual property licensing. In other words, the market is expecting management not merely to grow the business, but to transform the economics of the business itself. This explains why every quarterly result attracts so much attention. Investors are not simply checking whether profits increased. They are asking a much bigger question. Is the future arriving quickly enough? So what is our overall financial assessment? Revenue growth? Strong. Profit growth? Improving. Cash generation? Becoming healthier. Balance sheet? Comfortable. Capital efficiency? Still moderate. Working capital? Needs monitoring. Valuation? Demanding. These numbers neither fully confirm nor reject the investment case. Instead, they tell us something far more interesting. MosChip appears to be a company transitioning from a traditional engineering services business toward a higher-value semiconductor technology company. Transitions create uncertainty. They also create opportunity. Whether shareholders ultimately earn exceptional returns will depend on how successfully management completes this transition over the coming years. Because financial statements are not just records of the past. They are often early indicators of the future. In the next chapter, we will step into the minds of institutional investors. How do professional fund managers evaluate MosChip? What excites them? What worries them? And why can institutions remain patient for years while retail investors often lose confidence after a single disappointing quarter? Let's find out. Chapter 7: How Smart Money Thinks. Inside the Mind of Institutional Investors. Welcome back to Story Behind Stocks. Imagine two people standing outside the same apple tree. The first person asks, "How many apples can I sell today?" The second person asks, "How many apples will this tree produce over the next 20 years?" Both are looking at the same tree, yet they see completely different opportunities. That, in many ways, is the difference between short-term traders and long-term institutional investors. Retail investors often focus on tomorrow's stock price. Professional investors focus on tomorrow's business. And when institutions study a company like MosChip, they rarely begin with valuation. Instead, they begin with one simple question. Can this company become significantly larger than it is today? Because institutions understand a powerful truth. Extraordinary returns are rarely created by buying cheap companies. They are created by identifying businesses that can become many times larger over the next decade. So, if a professional fund manager were evaluating MosChip today, what would they see? Let's walk through their thought process. The very first thing institutions examine is not profit. It is the size of the opportunity. Imagine opening a coffee shop in a village with only 200 people. Even if you become the best coffee shop owner in the village, your growth remains limited. Now imagine opening the same coffee shop in a city where millions of people are moving every year. Suddenly, the opportunity becomes much larger. This is called the total addressable market. Simply put, it answers one question. How big can this business eventually become? For MosChip, the opportunity lies within one of the world's fastest growing industries: artificial intelligence, electric vehicles, industrial automation, cloud computing, 5G infrastructure, medical electronics, smart energy, Internet of Things, defense electronics. Every one of these industries requires increasingly sophisticated semiconductor chips. That immediately attracts institutional attention, because institutions prefer businesses where the industry itself provides a strong growth tailwind. The second question institutions ask is, does the company poses a competitive advantage? Anyone can start a software company. Very few can become trusted semiconductor engineering partners. Semiconductor design requires years of experience, specialized engineers, expensive software tools, customer confidence, and an almost flawless execution record. These characteristics create what investors call a competitive moat. Think of a castle surrounded by water. The wider the moat, the harder it becomes for competitors to attack. MosChip's moat is not built through advertising. It is built through technical expertise, customer trust, engineering capability, and decades of semiconductor experience. Management has stated that 10 of the world's top 20 semiconductor companies are customers. For institutional investors, this acts as a powerful signal of technical credibility because such customers typically follow rigorous vendor selection and qualification processes. Next comes perhaps the most important institutional question. Can the company continue growing rapidly for many years? 1 year of strong growth rarely excites professional investors. 5 or 10 years of sustainable growth does. MosChip's management believes growth will come from multiple engines simultaneously. Traditional semiconductor design services, turnkey ASIC projects, digital engineering, artificial intelligence, embedded software, semiconductor intellectual property, proprietary chip development, government-supported semiconductor initiatives. Institutions appreciate businesses with multiple growth engines because dependence on a single product becomes lower. If one engine slows, another may accelerate. The fourth question institutions ask is surprisingly simple. Can management actually execute? Ideas are inexpensive. Execution is priceless. Professional investors carefully compare management promises with actual achievements. Has revenue grown? Yes. Have customer relationships expanded? Yes. Has the company entered new geographies? Yes. Has it invested in future technologies? Yes. Has it begun moving toward high-value semiconductor products? Yes. These observations strengthen institutional confidence because management actions appear broadly aligned with management communication. Now comes the difficult part. Institutions also spend enormous time searching for risks. In fact, professional investors often spend more time asking, what could go wrong? Than asking, what could go right? Several risks naturally appear. The semiconductor industry remains cyclical. Large customers may delay projects. Technology evolves rapidly. Talent remains expensive. Competition continues increasing. High valuation leaves very little room for execution mistakes. These are genuine concerns. Institutional investors do not ignore them. They simply weigh them against the potential rewards. Another fascinating difference separates institutions from retail investors. Patience. Imagine planting a mango tree. During the first year, Nothing exciting happens. The second year appears similar. Even after several years, there may still be no fruit. An impatient person concludes the experiment has failed. A patient farmer understands the tree is still growing beneath the soil. Institutional investing follows a similar philosophy. Professional investors often remain invested through temporary disappointments if they believe the long-term business thesis remains intact. Retail investors frequently react to quarterly fluctuations. Institutions usually react only when the long-term story changes. This explains why institutional shareholding often remains remarkably stable despite short-term market volatility. They invest in business trajectories rather than quarterly headlines. However, there is one area where institutions become extremely disciplined: valuation. Even the world's best business can become a poor investment if purchased at an unreasonable price. Think of buying a luxury apartment worth 2 crore rupees. If someone asks you to pay 8 crore rupees, even the finest apartment becomes difficult to justify. The same principle applies to stocks. MosChip currently trades at a valuation that already assumes strong future growth. Professional investors, therefore, ask a very specific question: can earnings grow fast enough to justify today's expectations? This shifts the discussion from today's profits to tomorrow's potential. If management successfully expands margins, scales turnkey ASIC projects, commercializes proprietary semiconductor products, builds recurring intellectual property revenue, and continues winning global customers, then today's valuation may eventually appear justified. But if growth slows materially, valuation itself could become the biggest risk. This balancing act is exactly how institutional investors think. They're not searching for certainty. They are estimating probabilities. High-quality business, large opportunity, capable management, healthy balance sheet, multiple growth engines, balanced against execution risk, industry cycles, talent challenges, premium valuation. Every investment becomes a probability equation rather than a guarantee. Perhaps the biggest lesson retail investors can learn from institutions is this: great investing is rarely about predicting next month's share price. It is about continuously asking whether the business is becoming stronger. If the business keeps improving, time often becomes your greatest ally. If the business weakens, even a low purchase price cannot protect your capital forever. So where does MosChip stand today? From an institutional perspective, it appears to be a high-quality company operating in a structurally attractive industry with an ambitious management team and multiple long-term growth drivers. But it is also a company where expectations have already risen significantly. That means execution over the next several years will matter far more than quarterly excitement. Because ultimately, institutional investors do not buy stocks. They buy future cash flows. And the market rewards those companies that consistently transform future possibilities into present profits. In the next chapter, we will tackle the question every investor eventually asks: is MosChip actually worth its current valuation? How do professionals value high-growth technology companies? And what level of future growth would justify today's premium price? That is where our story takes its most fascinating turn. Chapter 8: The Big Question. Is MosChip worth its premium valuation? Welcome back to Story Behind Stocks. Every investor eventually reaches a moment where facts and emotions collide. You may discover an outstanding company. You may admire its management. You may believe in its future. But then you look at the stock price and ask yourself one simple question: am I paying too much? This is perhaps the most difficult question in investing. Because a wonderful company does not automatically become a wonderful investment. Price matters. Imagine walking into a luxury car showroom. A premium car worth 50 lakh rupees may be an excellent purchase at 50 lakh rupees. But would you still buy the same car if the dealer demanded 2 crore rupees? Probably not. The car hasn't changed. Only the price has. The same principle applies to stocks. A company can be exceptional. But if investors become too optimistic and push the price far beyond what future earnings can justify, even a great business can deliver disappointing investment returns. The company must grow profits even faster. Margins must improve. Return on capital must increase. Cash generation must strengthen. Higher value businesses like turnkey ASIC projects, proprietary semiconductor products, and intellectual property licensing must begin contributing meaningfully. Only then can today's valuation remain justified. Let's examine three possible futures. The first is the optimistic scenario. Suppose MosChip continues growing revenue at 40–45% every year. Imagine management successfully expands operating margins as turnkey ASIC projects become a larger part of the business. Suppose proprietary semiconductor products begin generating recurring revenue. Suppose intellectual property licensing gains traction. Now earnings could grow much faster than revenue. If earnings compound at 60–80% annually for several years, today's valuation may gradually become easier to justify. Notice something important. The valuation does not become cheaper because the stock price falls. It becomes cheaper because the business grows into its valuation. This is exactly how companies like Infosys, TCS, Asian Paints, Page Industries, Bajaj Finance, and many other long-term wealth creators justified premium valuations during their strongest growth phases. Now let's consider the second scenario. Revenue continues growing at 25–30%. Profits improve steadily. Customers increase. The business becomes larger. Most investors would normally celebrate such performance. Ironically, for a stock trading at 129 times earnings, that may not be enough. Why? Because expectations were even higher. In such situations, investors often experience something surprising. The business performs well. The stock performs poorly. Not because the company disappointed, but because expectations were simply unrealistic. Now let's examine the third scenario. Suppose semiconductor demand weakens for a few years. Customer projects get delayed. Margins remain under pressure. Hiring costs increase. Product development takes longer than expected. Growth slows below 20%. In that situation, valuation itself becomes the biggest risk. The business may still survive. Revenue may still grow. But investors could become unwilling to pay such a premium multiple. This phenomenon is called valuation compression. Think of it like a stretched rubber band. The further it stretches beyond its natural position, the greater the force pulling it back. Premium valuations always carry this hidden risk. This is why professional investors often separate two very different questions. Is this a great company? And is this a great stock at today's price? These are not the same question. MosChip may very well become one of India's important semiconductor success stories. That does not automatically guarantee extraordinary shareholder returns from every purchase price. Price always matters. Another interesting way to think about valuation is through the idea of expectations. Imagine two restaurants. The first promises ordinary food. The second advertises itself as the best restaurant in the country. If both serve good food, who disappoints customers more? Usually the second restaurant. Not because the food is bad, but because expectations were extraordinarily high. Similarly, premium stocks are judged by extraordinary standards. Investors no longer ask, did the company grow? They ask, did the company grow faster than everyone expected? This subtle difference explains why high-growth technology companies often experience sharp stock price movements even after reporting healthy financial results. The market is always comparing reality against expectations. So how should long-term investors think about MosChip? Perhaps the answer lies in understanding where the company is in its journey. This is not a mature business distributing large dividends every year, nor is it an early-stage startup with no revenue. MosChip sits somewhere in the middle. It already possesses credible customers, meaningful revenue, growing profits, healthy industry tailwinds, and ambitious management. At the same time, it is still investing heavily in research, talent, intellectual property, and higher value products. In other words, the company is still becoming what investors hope it will eventually be. That creates both excitement and uncertainty. The biggest opportunity comes from successful execution. The biggest risk comes from paying too much for future possibilities. So what is our overall conclusion? If MosChip successfully delivers sustained revenue growth of around 40% while expanding margins enough to produce earnings growth of 60 to 80% annually over several years, today's valuation may gradually become reasonable. But if growth settles closer to 25 or 30%, the business could continue improving while the stock struggles because expectations were simply too ambitious. This is why valuation is never just about mathematics. It is about expectations. And in investing, the gap between expectations and reality often determines returns more than the quality of the business itself. As Warren Buffett once explained in a different way, investing is not only about buying wonderful businesses. It is about buying wonderful businesses at sensible prices. In the next chapter, we will bring everything together. We will combine the business quality, industry opportunity, management capability, financial strength, institutional thinking, and valuation into one final investment framework. By the end of that chapter, you won't just understand MosChip. You will understand how experienced investors evaluate any high-growth technology company in the world. Chapter 9, The Final Verdict. Should MosChip be on your watch list? Welcome back to Story Behind Stocks. Over the past 8 chapters, we have traveled through the complete journey of MosChip Technologies. We explored its origins. We understood how it earns money. We studied the semiconductor industry. We examined management. We analyzed the financial statements. We looked through the eyes of institutional investors. And finally, we discussed one of the most debated topics, the company's premium valuation. Now comes the most important chapter of all. Not because we are going to tell you whether to buy or sell, but because we are going to answer a far more valuable question. How should a long-term investor think about MosChip? Because great investing is rarely about finding perfect companies. Perfect companies do not exist. Every investment is simply a balance between opportunity and risk. Imagine standing at the base of a mountain. One path promises breathtaking views, but demands a difficult climb. Another path is much easier, but offers fewer rewards. Neither path is right or wrong. The choice depends on your patience, your expectations, and your willingness to accept uncertainty. MosChip resembles the first path. The opportunity is enormous. The journey will almost certainly be volatile. Let's bring everything together. The first pillar is the business. MosChip operates in semiconductor design, a business built on knowledge rather than physical assets. Its products may not carry its own brand name, but its engineering expertise quietly powers technologies used across industries. The company is steadily moving beyond engineering services toward higher-value turnkey ASIC projects, semiconductor intellectual property, and proprietary chip development. If this transition succeeds, the economics of the business could improve dramatically. The second pillar is the industry. Rarely in history has one industry received so much global attention simultaneously. Artificial intelligence, electric vehicles, cloud computing, 5G, industrial automation, smart manufacturing, medical electronics, defense technology. Every one of these sectors depends on increasingly sophisticated semiconductor chips. Governments across the world are investing billions of dollars to strengthen semiconductor ecosystems. India itself is encouraging domestic chip design through multiple initiatives. Few companies are positioned at the intersection of so many structural growth themes. That creates a favorable long-term environment. The third pillar is management. Throughout our analysis, one quality repeatedly emerged: consistency. Management has not been chasing fashionable trends. Instead, it has patiently built expertise in semiconductor engineering while expanding into AI, embedded systems, digital engineering, risk-free technologies, proprietary products, and turnkey ASIC solutions. Their strategy appears coherent. More importantly, their actions broadly support their words. That does not guarantee success, but it does improve credibility. The fourth pillar is financial performance. Revenue has grown impressively. Profitability has improved. Operating cash flows have strengthened. The balance sheet remains comfortable. At the same time, returns on capital remain moderate. Working capital efficiency deserves continued monitoring. These numbers suggest a company that is still investing heavily for future growth rather than harvesting maximum profitability today. The fifth pillar is institutional quality. Professional investors generally seek businesses with large opportunities, capable management, strong customer relationships, multiple growth engines, and high barriers to entry. MosChip satisfies many of these characteristics. Its relationships with leading semiconductor companies, expanding capabilities, and participation in future technologies make it an interesting long-term business to watch. But then comes the sixth pillar, valuation. And this is where the story becomes more balanced. Markets do not reward good companies. They reward companies that perform better than already high expectations. MosChip's premium valuation tells us that investors are already expecting substantial future success. That means management cannot merely perform well. It must perform exceptionally well. Strong revenue growth alone may not be sufficient. Margins must improve. Capital efficiency must improve. High-value businesses must scale. Proprietary products must begin contributing. Only then can future earnings justify today's expectations. This brings us to an important investing principle. There are three kinds of businesses. The first kind has no future. The second kind has a bright future, but everyone already knows it. The third kind has a bright future that most people still underestimate. The greatest investment opportunities usually belong to the third category. Where does MosChip fit? That depends on your own conviction. Some investors believe the semiconductor opportunity is still underappreciated. Others believe the current valuation already reflects most of the future potential. Reasonable investors can honestly reach different conclusions. And that is exactly what creates a market. Now imagine we had to prepare an institutional-style scorecard. Business quality, excellent. Industry opportunity, outstanding. Management vision, very strong. Financial momentum, improving. Competitive position, strong. Balance sheet, healthy. Execution risk, moderate. Valuation comfort, low. Overall investment quality, high. Overall valuation comfort, demanding. This combination creates an interesting conclusion. MosChip appears to be a high-quality business, but not necessarily a low-risk investment. Those are two very different things. A wonderful business purchased at an unrealistic price can disappoint investors. An average business purchased at an attractive valuation can sometimes produce excellent returns. Successful investing requires balancing both business quality and valuation. Perhaps the biggest lesson from MosChip is not about semiconductors at all. It is about patience. Technology companies rarely create wealth in a straight line. There will be periods of excitement, periods of disappointment, quarterly fluctuations, temporary slowdowns, unexpected challenges. The companies that ultimately become industry leaders are usually those that continue investing through difficult periods while competitors become distracted. Whether MosChip becomes one of India's great semiconductor success stories will depend on decisions that management makes over the next decade rather than the next quarter. As investors, our responsibility is not to predict the future with certainty. Our responsibility is to continuously compare reality against the original investment thesis. If the business keeps improving, if management keeps executing, this brings us to the end of MosChip's story. But remember, every stock has a price. Every business has a story. The price changes every day. The story changes much more slowly. Successful investors learn to focus on the story first, and the price second. Thank you for joining us on Story Behind Stocks. If this documentary helped you understand not just MosChip, but also how to evaluate high-growth technology businesses, then our mission has been successful. Until our next documentary, keep learning, keep questioning, and always remember, the best investment decisions begin with understanding the business, not following the crowd.